Hello, everybody. I hope everybody's well. Today, I'm recording this on November 4th, 2021. Congress has not, at this point, passed legislation that would change the international tax rules. If between now and when the program goes live, if there's a change, I will record an updated lecture. Today we're going to be talking about section 245 capital A. It's a very important piece of the international tax changes made by the Tax Cuts and Jobs Act in 2017. It transformed the U.S. international tax system from a worldwide system to what people refer to as a quasi or hybrid territorial system with respect to domestic C corporations. By way of background, prior to the Tax Cuts and Jobs Act, the United States employed a worldwide system of taxation with deferral of the federal tax on the active business earnings of foreign subsidiaries until such amount were repatriated or deemed repatriated under certain anti-deferral code sections, chiefly subpart F. Under that former system, double taxation was mitigated through the allowance subject to various limitations of a credit for federal taxes paid or accrued by the foreign subsidiary with respect to the repatriated earnings. Given the relatively high rate of tax that the United States imposed on domestic corporations, taking into account both the federal and state taxes, combined with the steady decline in the corporate tax rates in the rest of the world, the prior U.S. international tax system, that is the one pre-2018, was generally considered to place U.S. multinationals at a competitive disadvantage relative to their non-U.S. competitors, and moreover, to give rise to a lockout effect that kept a significant amount of foreign earnings, by some estimates, several $1 trillion, from being repatriated to the United States. As we discussed earlier in the semester, under a territorial system, active foreign earnings are not generally subject to residence country taxation when repatriated as dividends, either through an exemption or through allowance of a deduction. With the transition by Japan and the United Kingdom to a territorial system of taxation before the enactment of the Tax Cuts and Jobs Act, the U.S. was the last of the G7 countries to remain with a worldwide system of taxation. As Professor Loken notes in paragraph 66.8.1, under section 245 cap A domestic corporation, he said, is allowed, I would say generally allowed, a deduction equal to the foreign source portion of any dividend received from a specified 10% owned foreign corporation. Section 245 little a in parenthetical provides the taxpayer satisfying a holding period requirement described below, and other requirements are entitled to domestic corporate shareholders are entitled to a 100% dividends received deduction. We're going to go through the requirements in next few minutes. It applies to something known as a specified foreign corporation, which is a corporation that is at least 10% owned, a foreign corporation, at least 10% owned by a United States shareholder. A United States shareholder, for purposes of 245 cap A, is a United States person owning 10% or more of the vote or value of the foreign subsidiary. Loken mistakenly uses the word voting stock. The Tax Cuts and Jobs Act changed the definition of United States shareholder to mean 10% or more of the vote or value. So I would modify his language in 66.81 to indicate the United States shareholder, for purposes of 245 Cap A, is a United States person owning 10% or more of the vote or value of the foreign corporation. Let's go. What I want you to do is I want you all to read the entire section 245 Cap A. Let me just highlight some of the provisions. Let's take a look at 245A, the title. Today, and again, it's 245 capital A. Take a drink of water. It's called deduction for foreign source portion of dividends received by domestic corporations from specified 10% owned foreign corporations. In general, in the case of any dividend received from a specified 10% owned foreign corporation by a domestic corporation, which is the United States shareholder, with respect to such foreign corporation, there shall be allowed as a deduction an amount equal to the foreign source portion of such dividend. B, specified 10% owned foreign corporation. For purpose of this section, 1, in general, the term 10% owned foreign corporation means any foreign corporation with respect to which any domestic corporation is a United States shareholder with respect to such corporation. Please note, under current law, 245 Cap A applies to foreign companies that are not, that can be a controlled foreign corporation or are not a controlled foreign corporation. There is certainly language that may be enacted between now and whenever that would change 245 Cap A to only apply to controlled foreign corporations. This is this Build Back Better Act. If in fact this language is included and this legislation passes, I will have a subsequent lecture talking about that. So they said 245 Cap A, B in parenthetical, 1 in parenthetical, provides the term specified 10% owned foreign corporation means any foreign corporation with respect to which any domestic corporation is a United States shareholder with respect to such corporation. And 2, exclusion of passive foreign investment companies. Such term shall not include any corporation which is a passive foreign investment company as defined in section 1297 with respect to the shareholder and which is not a controlled foreign corporation. So 245 Cap A excludes passive foreign investment companies known by the acronym PFIC, unless the PFIC is also a controlled foreign corporation. Let's look at 245 Cap A C, little c, in parenthetical foreign source portion. For purposes of this section, 1, in general, the foreign source portion of any dividend from a specified 10% owned foreign corporation is an amount which bears the same ratio to such dividend as A, the undistributed foreign earnings of the specified 10% owned foreign corporation, bears to B, the total undistributed earnings of such foreign corporation. And 2, undistributed earnings, under that caption, the code provides the term undistributed earnings means the amount of earnings and profits of the specified 10% owned foreign corporation computed in accordance with sections 964, little a in parenthetical, and 986. Cap A, as of the close of the taxable year of the specified 10% owned foreign corporation in which the dividend is distributed, and B, without diminution by reason of dividends distributed during such taxable year. The 945 Cap A, little c in parenthetical 3, titled undistributed foreign earnings, provides the term undistributed foreign earnings means the portion of undistributed earnings which is attributable to either A, income described in subparagraph A of section 245, little a, 5 in parenthetical, nor B, dividends described in subparagraph B of such section, determined without regard to section 245 little a in parenthetical, 12 in parenthetical. Let's focus on D now, which is disallowance of foreign tax credit. Very importantly, and we'll read it, but very importantly, the quid pro quo for 245 Cap A is you can't claim any foreign tax credits with respect to these dividends that are not taxed to the U.S. shareholder by virtue of 245 Cap A, that is 100% dividends received deduction. Anyway, D, 245 Cap A, little d in parenthetical is titled disallowance of foreign tax credit, etc. 1, in general, no credit shall be allowed under Section 901 for any taxes paid or accrued or treated as paid or accrued with respect to any dividend for which a deduction is allowed under this section. 2, in parenthetical, denial of deduction. No deduction shall be allowed under this chapter for any tax for which credit is not allowable under Section 901 by reason of paragraph 1, determined by treating the taxpayer as having elected the benefits of subpart A of part 3 of subchapter N. E, special rule for hybrid dividends. Before I read that, we'll see that hybrid dividends do not qualify for the Section 245 Cap A 100% dividends received deduction. In plain English, a hybrid dividend is a dividend in which the foreign country permits a deduction for the payment. They may do so because they may view the instrument not as equity, but as debt for local purposes. Let's read E1. In general, subsection little a in parenthetical shall not apply to any dividend received by a United States shareholder from a controlled foreign corporation if the dividend is a hybrid dividend. And 2, the caption, this is 245 Cap A E, little 2 in parenthetical, hybrid dividends of tiered corporations. If controlled foreign corporation with respect to which a domestic corporation is a United States shareholder receives a hybrid dividend from any other controlled foreign corporation with respect to which such domestic corporation is also a United States shareholder, then notwithstanding any other provision of this title, A, the hybrid dividend shall be treated for purposes of Section 951 little a in parenthetical, 1 in parenthetical, Cap A in parenthetical, as subpart F income of the receiving controlled foreign corporation, the taxable year of the controlled foreign corporation in which the dividend was received. And B, the United States shareholder shall include in gross income an amount equal to the shareholder's pro rata share determined in the same manner as under 951 little a in parenthetical, 2 in parenthetical of subpart F income described in subparagraph A, Cap A in parenthetical. What that means in plain English is if you have a vertical chain and say USP, US parent company, owns CFC1, doesn't have to be a CFC, but and owns CFC2. Let's make it a CFC, in fact. If the distributions from CFC3 to CFC2 are hybrid dividends, onerous things happen. They're going to be treated as subpart F income. So you really want to stay away from hybrid situations. All right, let's read. I'm not sure we read it yet, but let's read E3 in 245 Cap A, denial of foreign tax credit. The role of subsection D shall apply to any hybrid dividend received by or any amount included under paragraph 2 in the gross income of the United States shareholder. So you don't get any foreign tax credits for hybrid dividends, even though you don't get a benefit. You don't get a 245 Cap A benefit. 245 Cap A little d 4 is entitled hybrid dividend. The term hybrid dividend means an amount received from a controlled foreign corporation, A, for which a deduction would be allowed under subsection little a, but for the subsection and capital B in parentheticals, for which the controlled foreign corporation received a deduction or other tax benefit with respect to any income, war profits, or excess profits taxes imposed by any foreign country or possession of the United States. I'm going to skip F, special rule for purging distributions of passive foreign investment companies. I'm going to skip G, dealing with regulations. Please read that on your own. The general definition of a dividend under 316 little a in parenthetical that hopefully you've studied already from Professor Antonini in the advanced corporation tax course. That definition should control for purposes of section 245 cap A. Further, legislative history states that Congress intended the term dividend received, to be construed broadly, consistent with the meaning of the phrases amount received as dividends and dividend received as used in sections 243 and 245, respectively. As many as you know from taking Professor Anthony's course, section 316 little a in parenthetical defines a dividend as any distribution of property out of the distributing corporation's current or accumulated earnings and profits, referred to as E&P. Accordingly, whether an actual distribution constitutes a dividend for purposes of section 245 cap A should be decided based on existing guidance and case precedent under section 316 little a in parenthetical. As many of you know, distributions are considered as first paid out of current and accumulated earnings and profits. If you exhaust current and accumulated earnings and profits, then it's considered a return of capital, return of basis. When the distribution exceeds both current and accumulated earnings and profits and basis is down to zero, then it's generally considered to be gained from the sale or exchange. In most instances, ownership of shares should be a capital asset, so that gain should be capital gain in most instances. The big exception would be if you held the stock as a dealer, so the stock was inventory. In that event, it would be ordinary income as opposed to capital gain. As I think you should all know, under current law, U.S. corporations do not get a benefit for capital gain treatment. It's taxed at the same rate as ordinary income. Individuals, however, do get a benefit rate differential for both capital gains and qualified dividend income. Interestingly, and you should know this from your 316, from your advanced corporate tax course, where the corporation has a deficit in its accumulated E&P, a distribution nevertheless constitutes a dividend if paid out of current E&P. And as I said, you should have studied that in Professor Antonini's course. This concept is referred to as a nimble dividend, i.e. a dividend attributable to current E&P with respect to a corporation that has accumulated E&P deficit as of the end of both the prior year and the current year. This has some relevance with respect to determination of the foreign source portion of the dividend. Recall that under 245 cap A, you get 100% dividends received deduction only to the extent that the dividend represents, foreign source earnings. One commentator observed the following, and I'm not going to test you on it, and I'm not sure that he's literally correct if you read the statute, but query whether there'll be regs that will change the result. He points out that if the foreign corporation has a deficit in accumulated E&P greater than its positive current E&P, it would not have positive undistributed foreign earnings. In that case, the foreign source portion of a dividend paid by that foreign corporation could be zero because the numerator or denominator of the fraction used to determine that amount would be negative. So, I mean, you could have foreign source earnings in the numerator, but what happens at the denominator, which constitutes all earnings and profits, current and accumulated, is a negative number. This commentator argues it appears that you wouldn't be able to get a dividends received deduction because how could you calculate the foreign source portion where the overall portion is zero? That is the undistributed earnings. It's an academic point. Well, it could have real life ramifications. It won't have it on your exam, however. Professor Logan writes in 66, 8.1 second paragraph, the foreign source portion of a dividend is the amount of dividend multiplied by the corporation's undistributed foreign earnings and dividend by the corporation and divided, by the corporation's total undistributed earnings. See section 245 cap A, little c in parenthetical, 1 in parenthetical. The last point I'd raised was what happens if that denominator is a negative number or a zero. A corporation's undistributed earnings are the corporation's earnings and profits as of the close of the taxable year, during which the dividend is distributed without diminution by reason of dividends distributed during such taxable year. All undistributed earnings are undistributed foreign earnings except one, amounts subject to U.S. tax as income effectively connected with the conduct of a trade or business in the United States. We talked about that earlier in the semester, if you recall in the introduction. And two, dividends received from a domestic corporation, at least 80% of the stock of which by vote and value is owned by a 10% owned foreign corporation. As Logan notes, the key is that the entire amount of a dividend is considered foreign source if the foreign corporation has no U.S. trade or business and is not a shareholder of any domestic corporation. The latter, again, refers to a sandwich structure in which you've got a domestic corporation on top, a foreign corporation in the middle, and a domestic corporation on bottom. That's one type of sandwich structure, and that's the type that we're referring to now. Logan addresses the requisite holding period for section 245 cap A to apply in paragraph 66.8.1, third paragraph. He writes the section 245 cap A deduction is allowed only if the taxpayer holds the shares for more than 365 days during the 731-day period, beginning 365 days before the dividend becomes ex-dividend with respect to the dividend. Ex-dividend, by the way, I'm not sure you're familiar with the term. It means that the declared but yet unpaid dividend does not go to the buyer, but stays with the seller. So generally, all things being equal, when stock goes ex-dividend, it drops in value because the buyer doesn't get the declared but unpaid dividend. Logan goes on to write, a day is included in the taxpayer's holding period for purposes of this rule, only if on that day the foreign corporation is a specified 10% owned foreign corporation, and taxpayer is a U.S. shareholder of the corporation on that day. He cites the correct site for that is section 246, little c in parenthetical, 5 in parenthetical, cap B in parenthetical. I think there's a typo in footnote 12, and it mistakenly refers instead to 246, little c in parenthetical, 1 in parenthetical, cap B in parenthetical. So again, I think the correct citation is 246, little c in parenthetical, 5 in parenthetical, cap B in parenthetical. Also, the deduction is not allowed to the extent, this is the 245 cap A, dividends received deduction, is under an obligation to make related payments with respect to positions in substantially similar property. Jack Cummings, in a very good article on the March 12th, 2018 tax notes, entitled "The Foreign Dividends Received Deduction," he points out that regulations expanding on Section 246 ignore periods of stock ownership during which the taxpayer shareholder's risk of loss is diminished because of hedges, options, etc. The ways risk of loss can be diminished are surprisingly broad and should be examined if a shareholder enters into any contracts regarding the stock. I think the key point here is you're not going to count days in which you've hedged your position such that you don't really care whether the stock goes up or goes down. Maybe I've oversimplified that, but that's the key point. As to foreign tax credits, Professor Loken covers that in 66.8.1, fourth paragraph. Excuse me for a second. A domestic corporation is allowed no credit deduction for foreign income tax on a dividend from a foreign corporation. It was allowed a deduction for the dividend under these rules. The site is section 245, cap A, little d in parenthetical. We had read that earlier. Also, the corporation's limitation under section 904 on the foreign tax credit is computed without the foreign source portion of dividends from specified 10% owned foreign corporations and without deductions properly allocable to that income. Let me see if I can explain that better, although he's got an example coming up. To the extent that the dividend comes within 245 cap A, that is, you get the 100% dividends received deduction, on that dividend, the foreign source piece of that dividend. What transpires is you can't use any foreign tax credits. You can't claim credits for any taxes that arose because of the dividend, like withholding tax. And for 904 purposes, 904 requires that you have sufficient net foreign source income in order to be both by overall and by category or basket in order to claim a foreign tax credit. Well, 245 cap A does a few things. One, it says you can't claim the credits. And two, it says that the dividend, will not give rise to foreign source income for section 904 purposes. So it's useless with respect to foreign tax credits. And Loken's example, again, I'm at 66.8.1, fourth paragraph is as follows. Assume USCO, a Delaware corporation, owns 60% of the stock of FCO, a corporation organized in the laws of foreign country F. If country F imposes a withholding tax on dividends paid by FCO to USCO, and USCO qualifies for a 245 cap A deduction with respect to these dividends, USCO may not take a foreign tax credit or a deduction for the withholding tax, and its 904 limitation is computed without including the dividends or deductions allocable to the dividends. As I explained earlier in the semester, Professor Loken is referring to the fact that foreign tax credit usage is predicated on having sufficient net foreign source income, both overall and by category or basket under section 904. By the way, even absent the section 245 cap A, little d in parenthetical, the provision disallowing foreign tax credits, I'm sorry, 245 cap A, little d in parenthetical, is the provision disallowing foreign tax credits and deductions for dividends coming within the 245A. I just want to point out to you that with respect to indirect or deemed pay credits, and I'm referring to a dividend rather than a subpart F inclusion or a GILTI inclusion, that was repealed. This is old section 902. This was repealed by the Tax Cuts and Jobs Act of 2017. Jack Cummings, in his article about 245A, gives an example as to how Section 245 Cap A applies to foreign withholding tax on a dividend to a domestic parent company. So here's his example. Assume a $10 withholding tax on a $100 inbound, meaning to the United States, dividend, for which an $80 deduction is allowed. Why only 80? Well, presumably 80% of the dividend was foreign source. The other 20% was presumably domestic source. And again, you only get the 245A dividends received deduction to the extent it's foreign source. He goes on to write, $8 of the credit will be disallowed by Section 245 Cap A little d, and Section 245 little a in parentheticals, 8 in parenthetical, will disallow $2. The example illustrates, in legislature history, indicates that the foreign tax credit disallowed by Section 245 Cap A little d in parenthetical only applies to the amount of the dividend qualifying for the 100% dividends received deduction. In this case, the $80, the $100 inbound dividend. It's a bit academic since Section 245, little 8 in parenthetical, 8 in parenthetical, denies foreign tax credits on the other $20 of domestic source income in its example, with Section 245, little 8 in parenthetical, 8 in parenthetical, providing that no credit shall be allowed under Section 901, which is the regular foreign tax credit, for any taxes paid or accrued or treated as paid or accrued with respect to the United States source portion of any dividend received by a corporation from a qualified 10% owned foreign corporation. The next point I want to cover is that Section 1248 little j provides generally that any gain recognized by a domestic corporation from the sale or exchange of stock in a foreign corporation held for at least 1 year that is treated as a dividend under 1248 little a in parenthetical, which applies to United States persons owning 10% or more of the voting stock of a CFC or former CFC within a 5-year look-back rule, shall be treated as a dividend for purposes of Section 245 Cap A. This also covers E&P of lower tier entities held by the divested foreign corporation. What essentially, let me just go through quickly 1248 with you. I think I had briefly touched upon it in the introduction, but suppose you had the following fact pattern. You've got a U.S. United States shareholder owning, say, CFC, owning a CFC. He owns it 100%, and he's owned it for a number of years. Let's suppose that the basis in the CFC is 50 and its fair market value is 100. So absent 1248, you would have 50 of cap gain, right? 100 amount realized, amount received, less 50 of basis. So your realized gain would be 50. What 1248 essentially does is, to the extent of earnings and profits, it transforms that gain into dividend income. What 1248J does in conjunction with 245 Cap A is that if you've met the requisite holding period and other requirements, that $30 of dividend is excluded from gross income. So it can be a very beneficial provision. Jack Cummings, as I said, it also applies if you have a vertical chain, say USP owns CFC1, which in turn owns CFC2. It would apply to the earnings and profits both in CFC1 and CFC2. Jack Cummings, in his Section 245A article, points out that when a CFC sells stock of a foreign corporation, Section 964E can treat part of the gain as a dividend. If Section 1248 would have applied to the same sale if made by a U.S. person, the gain would be subpart F income, as would be a dividend, but dividend treatment has had, until the enactment of changes made by the Tax Cuts and Jobs Act, the extra benefit of qualifying for something known as the 954C6 look-through rule. Very briefly, and I'm oversimplifying it, what 954C6 does is it says that interest, dividends, rents, and royalties paid from one CFC to another CFC can avoid being treated as subpart F foreign personal holding company income if those earnings are traceable. The dividend, interest, rents, and royalties, if the earnings that give rise to these payments are traceable to active income, there's another requirements, then it's not foreign personal holding company subpart F income. Sorry I had to go through that, but you need that understanding, I think. So what goes on here is that, this 964E4 provision, treats the entire gain. So I think I had a fact pattern where we sell for 100, basis is 50, what did I say, 30 of E&P, I forgot what I said. Let's suppose 30 of E&P. You met the requisite holding period and the other requirements, then that 30, all 50 becomes subpart F income, taxable to the U.S. shareholder, except to the extent of E&P. 30 qualifies for 245 Cap A dividends received deduction. This can be a significant benefit. I'm sorry. I should have prefaced my last couple of comments. What I was referring to, let me step back for a second, because I now realize I think I may have confused you. If you have just a straight sale of a U.S. parent company owning a CFC, yeah, and you had basis of 50, fair market value of 100, 30 of E&P, you've met the requisite holding period, then of the 20 of, there's 50 of gain, 30 would be treated as earnings and profit. 30 of E&P would be treated as dividend and can get 245 Cap A dividends received deduction relief. I said that was also true if USP owns CFC1, which in turn owns CFC2, and you sell CFC1, you look both at the E&P in CFC1 and the E&P in CFC2, and both earnings and profits can give rise to a dividends received deduction. The balance, would generally be capital gain. What I started to talk to you about, and I should have prefaced it, was a provision in 964E addressing a fact pattern where in a vertical chain, say a USP owns CFC1 that owns CFC2, and CFC1 sells CFC2. The big picture here is that the entire gain is initially treated as subpart F income. You don't get look-through rules. You get the entire gain is subpart F, which is in the first instance bad because Subpart F is taxable to the US shareholder, but to the extent of earnings and profits in the divested company, you should generally be able to get the 245 Cap A dividends received deduction. So if I've got USP owning CFC1 and it sells CFC2, and CFC1's basis is 50, and the fair market value is 100, and there's 30 of E&P, at the outset, you'd have 50 of Subpart F income, but 30 of that would qualify for 245A treatment. So you'd only be taxed really on the capital gain piece, the other 20. I hope that's clear. If not, I probably won't test you on anyway, but if not, shoot me an email. Next point I wanted to mention is an important conceptual one. 245A, would not be necessary in fact patterns where the foreign subsidiary has previously taxed income, or in the words of regulations, previously taxed earnings and profits. This is because U.S. tax rules essentially say that the earnings are never going to be taxed twice. So the earnings had already been subject to taxation by virtue of the transition rules of 956 or Subpart F, et cetera. It wouldn't be taxed to the U.S. shareholder a second time when it was actually distributed back to the U.S. shareholder. Obviously, when those come out first, when those previously taxed earnings and profits, or previously taxed income, I mean the same thing, have been exhausted, 245 Cap A becomes a very, very important provision for the domestic corporate taxpayer. I want to now point out something that at this point, on this date, November 4th, 2021, appears incorrect in the Loken textbook. And that's paragraph 66.8.2. Let's read it together. Professor Loken writes, the 245 Cap A deduction may also be allowed to a domestic corporation with respect to a gross income inclusion under 951, little a in parenthetical, 1 in parenthetical, to the extent the inclusion consists of dividends received by a CFC from another foreign corporation. If the domestic corporation indirectly owns at least 10% of the distributing corporation. He gives the following example. Assume X, a country X corporation wholly owned by USCO, a Delaware corporation, receives a dividend from YCO, a country Y corporation wholly owned by XCO. If the dividend is included in XCO's Subpart F income and all other conditions for the allowance of the deduction are satisfied, USCO may be allowed a deduction equal to the portion of the Subpart F inclusion resulting from the dividend, fully offsetting the Subpart F inclusion income from the dividend. Well, there's certainly some support for this position in the legislative history to Section 245A. It's not included in the statutory language, and the Treasury Department and the IRS have indicated, while they are still studying this matter, at this point in time, they don't believe they have the power to write regulations that apply the 245 Cap A relief to into the circumstances described by Professor Loken. Now, it's possible that they can change their mind in the next few months. If they do, I will update you on it. But at this point in time, I think that the language in the Loken textbook is misleading. I just attended a course myself by Practicing Law Institute. I'm a professor, but I'm also a student, and I attend every year their corporate tax mergers and acquisitions seminar. And the speaker from Treasury was asked again about this, and he basically said, we're still studying it, but at this point, we don't think we have the power in the statute to write regulations that cover that cover it, cover what Professor Loken described. Let's turn in your text to 66.8.3, hybrid dividends. I mentioned that when we went through the statute. Hold on one second, please. And Loken writes in 66.8.3, titled hybrid dividends. So he writes, the deduction is not allowed for hybrid dividend, which is an amount received from a CFC, for which the CFC received a deduction or other tax benefit with respect to any income or profits or excess profits taxes imposed by any foreign country of possession of the United States. He goes on to write, assume USCO is the sole shareholder of XCO, a corporation organized in the laws of a foreign country, X. If the tax laws of country X allow XCO a deduction for dividends paid by USCO, these dividends are hybrid dividends, and USCO is allowed no Section 245A deduction for these dividends. Notwithstanding denial of the 245 Cap A deduction, no credit deduction is allowed for foreign income tax on a hybrid dividend. For example, if a country X imposes a withholding tax on dividends paid by XCO to USCO, USCO is allowed no credit deduction for the withholding tax. He goes on to write, moreover, if a CFC receives a hybrid dividend from another CFC, and domestic corporation is a U.S. shareholder of both corporations, the hybrid dividend is subpart F income of the CFC receiving it, and the domestic corporation must include its ratable share of the income in its gross income. Assume USCO owns the stock of XCO, which owns the stock of YCO, a country Y corporation, and YCO is the sole shareholder of ZCO, which is organized in the laws of country Z. If country Z allows ZCO a deduction for the dividends it pays to YCO, these dividends are hybrid dividends and are therefore treated as subpart F income of YCO, which is bad news because that means it's taxable to the U.S. owner. Assuming the U.S. owner is a United States shareholder. Let me mention a few more points concerning Section 245 Cap A. To the extent that the distribution of the earnings to domestic corporation shareholder, as I said, represents previously taxed income, which is referred to in the regulations as previously taxed earnings and profits, because of the transition tax of 965A or subpart F or GILTI or et cetera. Even if Section 245A didn't exist, you wouldn't be taxed. I mentioned that earlier. Next point, Section 245 Cap A only applies to C corporations. It doesn't benefit individuals. An individual can't obtain access to the 245 Cap A benefit by making something known as a 962 election to be treated as a corporation for subpart F and GILTI. Briefly, 962 allows an individual to elect to be treated as domestic corporation with respect to benefits for GILTI and subpart F. In the case of GILTI, it includes a dividends received deduction and foreign tax credits. In the case of subpart F, it opens up foreign tax credits. Again, if an individual makes an election to be treated as a corporation, but an individual can't make that election to be treated as a corporation to come within 245 Cap A. So if you're an individual, you simply can't get the benefits under current law for 245 Cap A. Next point I wanted to mention, suppose you've got a US company having a branch. Say US company doesn't have a subsidiary, but has a branch in India, has a factory in India, a branch, not a separate company. 245 Cap A has no application whatsoever to income from a branch, only applies to dividends. S corporations can't claim the 245 Cap A dividends received deductions. You should have studied when S corporation is, and I think as part of your advanced corporate tax course. Let me now mention the interplay between section 245 Cap A and section 961 little d in parenthetical. Let's read section 961 D, titled Basis and Specified 10% Owned Foreign Corporation Reduced by Non-Tax Portion of Dividend for Purposes of Determining Loss. So 961 little d in parenthetical provides the following. If a domestic corporation received a dividend from a specified 10% owned foreign corporation, as defined in section 245 Cap A, in any taxable year, solely for purposes of determining loss on any disposition of stock of such foreign corporation in such taxable year or any subsequent taxable year, the basis of such domestic corporation in such stock shall be reduced, but not below zero, by the amount of any deduction allowable to such domestic corporation under section 245 Cap A with respect to such stock, except to the extent such basis was reduced under section 1059 by reason of a dividend for which such deduction was allowable. In essence, and in plain English, what section 961 little d does, and that section was enacted as part of the Tax Cuts and Jobs Act, it serves to reduce the stock basis of a specified, of a corporation falling within the ambit of 245 Cap A, only for loss purposes by the amount of the allowable section 245 Cap A deduction, unless the basis was already reduced under section 1059, which addresses extraordinary dividends. I was going to go through 1059 with you. I think you probably covered 1059 in your advanced corporate tax course. So I think I'm not going to go through it with you. I do want to point out that section 1059 was amended to specifically apply to 245 Cap A distributions. When 1059 kicks in, you can have a reduction in basis with on large extraordinary dividends, a defined term, and if you reduce your basis down to zero, that could trigger gain. So 1059 can be a nasty section. It does apply to 245 Cap A. Just quickly, Jack Cummings pointed out, as I mentioned earlier, that the Tax Cuts and Jobs Act amended section 1059 to apply specifically to section 245A. Therefore, some foreign source dividends producing a dividends received deduction can result in a loss of basis of the stock of the 10% owned foreign corporation. Cummings indicates that section 1059 is a quote unquote a sneaky rule. Under current law, it will, however, not apply to a CFC that the United States shareholder organized and has always owned. It can apply to a newly purchased CFC, but if the CFC had made a 338G election, then the ENP should have been eliminated, at least up to that point. Um, there are some, this Build Back Better Act, which has not been enacted as of today, November 4th, 2021. There's additional nasty provisions, anti-taxpayer provisions, with respect to the 245 Cap A 1059 overlap, whether or not they'll be included in the final act, or whether the final act, something will be enacted. It's possible nothing is enacted. We'll see. Again, if something is enacted before the course actually begins, I'll just have a lecture covering all the changes, including this change. One writer warned that, I'm talking about current law, in many cases in which Section 245 Cap A applies to a distribution by a CFC, the dividend will likely be an extraordinary dividend within the meaning of Section 1059 little c in parenthetical, such as the corporate U.S. shareholder will want to ensure that it has held the stock of the distributing CFC for more than 2 years as of the dividend announcement date. 1059, as it in the current law, has this 2-year rule. That if you haven't held it, if you held it for that requisite period of time, 1059 doesn't kick in. Another significant concern that Blanchard raised is that when a CFC has 2 or more shareholders and not all of them participate in the distribution will constitute what's known as a non-pro rata redemption, described in 1059 little e in parenthetical, 1 in parenthetical, Cap A in parenthetical, 2 little i's in parenthetical. For these non-pro rata distributions, Section 1059 little a cannot be avoided by holding the CFC stock for more than 2 years before the distribution announcement date. Again, these additional details, all I want you to know with respect to 1059 in terms of an exam is the application of 961D little d in parenthetical, that you can have a basis reduction if 1059 is not already applied, only with respect to dispositions of the foreign corporation that would give rise to a loss. Doesn't apply to gains. Jack Cummings also points out that under current law, again, things could change with this new act, expense associated with the stock that produces deductible dividends remains deductible, and that would include interest incurred to buy stock in the foreign corporation. Next point, I think I mentioned Section 78 gross up in earlier class, where in foreign taxes creating foreign tax credits under Section 960 for subpart F and GILTI inclusions are treated as taxable dividends. This in effect reduces the benefit, economic benefit of the foreign tax credit. Prior to the repeal of the deemed paid or indirect tax credit under Section 902 of the Tax Cuts and Jobs Act, Section 78 had the same effect on the foreign taxes, giving rise to Section 902 foreign tax credits. That last piece has been repealed, so it's not in Section 78. Jack Cummings notes that the Tax Cuts and Jobs Act amended Section 78 to ensure that the deemed dividend under Section 245A, he's talking about GILTI and subpart F, that deemed dividend under Section 78, what I'm referring to again is the taxes that are being brought back as credits. Those taxes, are treated as a dividend under Section 78. but 78 was amended to make sure that you don't get a 245 cap A benefit for the deemed dividend under section 245. You don't get a 245A dividends received deduction to the extent that the dividend the deemed dividend for the taxes came back to you under section 78. Excuse me for a second. Okay, it stopped. I hope you understood what I said. I finally just wanted to quickly mention there are some regulations that are not covered presently in the Loken book, I don't believe, dealing with something known as extraordinary dispositions and extraordinary reductions. Neither of these concepts will be on the exam. These regulations were finalized in August 2020. They're known as the extraordinary transaction regulations. And they denied 245A deduction for the what's known as the ineligible amount, if any, of a dividend from any specified foreign corporation. This is Treasury Decision 9909, issued on August 27, 2020. Under the regulations, the ineligible amount of the dividends, that is the amount not qualifying for 245 cap A, is 150% of the dividend's extraordinary disposition amount of any, and 2, 100% of the dividend's extraordinary reduction amount, if any. An extraordinary disposition amount arises with respect to any specified foreign corporation where the specified corporation had generated net gains from certain dispositions during the period between January 1st, 2018 through the close of the specified corporation's last taxable year to which the GILTI provisions do not apply, and generally a time when specified foreign corporation was a CFC. It was intended to address perceived transaction year abuses. The transaction, we'll cover this when we cover 965, but the transaction year, the year before, the year before, all of these international tax provisions from Tax Cuts and Jobs Act kick in, including 245A. So as I said, it was intended to address perceived transition year abuses by fiscal year specified foreign corporations by reason of a disposition to a related party outside the ordinary course of the specified foreign companies, corporations, activities during the period between December 31st, 2017 and the close of the SFC's tax years, and ends after December 31st, 2017. In the view of the Treasury, IRS, the partial disallowance of Section 245 Cap A DRD with respect to an extraordinary disposition amount is appropriate because Congress intended for 245A to apply only with respect to residual E&P that remained after the interrelated regimes of Section 965, which we'll cover in the next topic, Subpart F, GILTI, how they all apply to CFC income. Under this view, E&P arising from what is referred to as a highly structured transactions by CFCs during something known as the disqualified period, and thus not subject to any of these regimes, should not be afforded a full Section 245A dividends received deduction. Since the extraordinary disposition regulations have limited scope in terms of the time period for which they apply, I'm not going to go through the mechanics, and it certainly won't be on the exam. In contrast, the extraordinary reduction regulations has a much broader and adverse impact to taxpayers otherwise eligible for the Section 245A dividends received deduction relief, and impacts a sale of a foreign subsidiary otherwise falling under section 1248J. Remember I told you 1248J in conjunction with 245 cap A can give you a dividends received deduction on these earnings and profits of a divested CFC in a 1248 transaction. Under these regulations, a dividend or a deemed dividend from a CFC I'm sorry, what the rules provide is that the extraordinary reduction amount generally will no less than the amount equal to the sum of the shareholders' pro rata share of CFC subpart F income and guilty income taxable year would have been absent the relevant transactions included in income. Let me see if I can explain this again in plain English with an example. I'll try to do a very simple example. Again, it won't be on your exam. Let's suppose I've got a US shareholder, T, a domestic C corporation. It owns 100% of CFC, which it sells in the middle of the year. Suppose T's basis in CFC is $100 and the selling price is $500. And there is $400 of earnings and profits in CFC, none of which represents previously taxed income. So again, I hope you understand the picture. US parent got a basis of 100. Fair market value of CFC is 500. There is 400 of earnings in that CFC. And let's suppose that a substantial portion of those current earnings are subpart F and or guilty items that would have been included if the US shareholder had not sold the subsidiary before year end. Well, you haven't studied it. We'll look at guilty later in the semester. But both with guilty and subpart F, the inclusion generally occurs at the end of the CFC's taxable year. So let's suppose that the CFC's taxable year is December 31st, and a sale occurs in the middle of the year. No guilty or subpart F income would be included or deemed included in the US shareholder because the year hasn't come to an end. The US shareholder is selling the shares middle of the year. The year hasn't come to an end. Well, you haven't studied it yet. I studied this in the International Tax 2 course, which is not part of your program. 951, little a in parenthetical, 2 in parenthetical, and cap B in parenthetical, essentially purges to the buyer these bad earnings and profits. These earnings that would have given rise to guilty or subpart F income if held at the end of the year. What the service was concerned about was scenarios whereby when you sell the stock, it's treated as a deemed dividend to the extent of earnings and profits. That would normally give rise to a dividends received deduction benefit. But those earnings, the guilty and subpart F, have been effectively purged in this transaction by virtue of 951A2B. So the buyer of the stock, doesn't get them. And the seller all he gets is the benefits. He gets a major dividends received deduction without picking up subpart F and GILTI. So what these regulations do is, in effect, is that they reduce the 245 cap A benefit to the extent that these earnings would have given rise to GILTI and or subpart F income if held at the end of the CFC's year, by say the seller. I think that's all I'm going to say about these regulations. They won't be on the exam. By all means, you can shoot me questions about it, but I certainly won't test you on it. What I meant to do today, but I'll try to do it on our next lecture dealing with 965, is point out the pages in the Steptoe and Johnson handout that I gave you with respect to the major changes made in the international tax provisions, the Tax Cuts and Jobs Act. One word of caution, these PowerPoints were prepared in January of 2018. So while they're very good in terms of covering the statute, they don't cover for further guidance in the form of regulation or otherwise issued by Treasury IRS. But I think they're good for the 245 cap A. They're pretty good with the 965. So I will try to, at the next lecture, use them, including maybe give you a quick overview of the slides with respect to 245 cap A. Anyway, that's it. If it's evening for you guys, have a good evening. And again, please feel free to email me any questions. You take care. Bye.